Welcome to Berlin. I think you're in the right city at the right time. You have beautiful weather outside. You're less than a mile from the fan mile, where in the evening you can watch football World Cup games. So I assume that you are in this room now at this point in time means that you indeed at least find some of the topics here interesting and intriguing. I wish you a very good conference with this agenda. I too, when having had a look at your agenda, expect that you will have interesting discussions, as this conference looks at the challenge of making decisions under permanently shifting and sometimes not so clear economic conditions. This is a challenge that most global and European finance ministries, regulators, central banks face, as well as, of course, market participants. And I also do not want to exclude the possibility that at least sometimes regulators contribute to this challenge. Constraints of capital and collateral, excess central bank liquidity, persistently low interest rate environment, and other features of today's economic landscape are immediate and indirect consequences of a crisis we have not yet fully overcome. Unemployment, government debt, and other vulnerabilities in many countries are still omnipresent. They come along with understandable frustration and open discontent, and I think it's important to take note of that, of the population in many countries with respect of the consequences of necessary reform measures, not only in the financial sector. More than one elected government lost its electorate's trust on the way. I think that the crisis has also changed most governments' views on how to look at systemic financial risk. Today, all major governments worldwide agree in principle, I think that's important, in principle that these risks need to be addressed on a global level. The G20 Forum and the Financial Stability Board was established for exactly this purpose. Governments all over the world are amending their regulatory systems by adding macroprudential concepts. I think they will still need to prove their value, but it is a new concept and a new system in place. Regulatory oversight today appreciates and anticipates that even marginal individual business decisions, if taken on a large scale, can, together with adverse market incentives, have the capacity to become sources of significant systemic risk. Compared to before the crisis, governments share a clearer appreciation that decisions made in the public sector, as opposed to those in the private sector, can differ due to divergent emphasis of interests and responsibilities. Government policies need to be in account with factors of common interest like general welfare, democratic decision-making, individual rights, overall market functioning, transparency and fairness. For private participants, incentives and goals can differ, especially on the short term. Their perception of risk can therefore be irrelevant and must be irrelevant, but not the sole benchmark for government decisions. Looking back at some policies before the crisis, this conclusion is not as self-evident as it seems today. What governments and market participants clearly share, however, is a strong interest in financial stability. Efficient and reliable financial markets are implicit preconditions for most business models. And I'd like to give you a very brief overview of what, in our view, were the most important reforms in the last years and what lies in front of us. These shifted biases clearly had an impact on most government regulatory actions since 2008. And we have a lot of measures to look back to. First of all, we stabilized the financial systems. Governments around the world increased public spending to make up for faltering private demands, and central banks aggressively expanded their balance sheets and lowered interest rates distinctly. And I think we live in an environment now, especially here in Europe, where this has a lot of impact on markets. Secondly, the G20 countries and governments went out to build the missing safeguards through fundamental regulatory reforms. And I think as financial sector professionals, you certainly do know that these reforms are happening and that they are fundamental. That contrasts quite sharply to the public opinion of the degree of reform implemented. If you ask the general public, their impression of how much has actually been done differs significantly of what the sector and the regulators' assessment is. As you're familiar with the main reforms, I will just mention a few. I think one very important set is the comprehensive regulation of OTC derivatives. And we are also implementing a globally consistent legal entity identifier system for every market participant. We have substantially stronger capital and liquidity standards for banks. And we started to take a much closer look at credit intermediaries outside the banking system. I will get back to the issue of shadow banking, and I do agree with what Stephen said last year on the appropriateness of the term. However, it is a term which is established in the regulatory debate, so I will continue to use it. We established or enhanced monitoring and regulation for investment funds and their managers, with a particular focus on money market and alternative investment funds. We also addressed dangerous short-term incentives based on short-term thinking with regard to compensation. And we finally, international governments are seriously approaching the issue of too big to fail. I think that's still one of the most important topics on the regulatory agenda. We have identified systemically important banks and insurance companies. We are incrementally enhancing their thorough and globally consistent monitoring and regulation. In Europe, we are in the process of establishing centralized supervision of all major banks. The ECB will take over the responsibility in November this year. We will have a single resolution mechanism for resolving banks, and we will have harmonized deposit guarantee schemes. And I think that is the most significant transfer of sovereignty in the Eurozone and the Euro area since the inception of the Euro itself. This is where we are. Looking ahead, there's still a lot that needs to be done. And it's not so much a question of many, many more completely new rule works and rule books. I think the biggest challenge is implementing what actually has been agreed. And I think you will grapple and you will see the consequences of that in your daily work. So there's a lot to be done to see how this works, how it works together, how it can be implemented, and whether it actually achieves the desired objectives. But there are also still a number of issues which are open on the regulatory agenda. First, we need to get rid of implicit state guarantees for banks or other financial institutions. According to IMF estimates, the world's largest banks alone benefited from such implicit government guarantees or subsidies worth of $630 billion in 2011 and 2012. The way to alleviate this distortion is to ensure that even the biggest internationally connected players are resolvable without public support. Germany has early on in 2011 established a bank restructuring law that provided its supervisors with the powers necessary for early intervention and resolution, and it set up an industry fund, and the same is now being repeated on a European level. However, the worldwide financial stress after Lehman's fall has taught us that the resolution of large international players cannot be dealt with by any single country on its own. This is why in Europe we have the single resolution mechanism where we need to go beyond. What is very important is the underlying principle in the new resolution concept, and I think that really is a major change of the framework and the concept. The European fund can only be used after private creditors contributed to the largest part of resolution costs, meaning that at least 8% of the balance sheet of institution going into resolution has been provided for by the instrument of bail-in. In the future, resolution costs of a failing bank will be borne by shareholders and creditors. Public funds can only be used as a very last resort. I think this distribution is essential, not only for proper functioning of market economies, but also for ensuring acceptance of this sort of system in a democratic society. Internationally, we are pursuing the same goal. All of the G20 governments subscribe to the key attributes of effective resolution regimes for financial institutions established by the Financial Stability Board in 2011. We expect the FSB to recommend concrete proposals for a quantitative minimum requirement for gone loss absorbing capacity by the Brisbane Summit this year. This is important to make sure that the bail-in rules and goals which are set in our legislation actually can be implemented, that we are sure that sufficient bail-inable material is available in a time of a crisis. This should be, in our view, a clear common standard set at a level sufficient to guard against the systemic risks of GSIBs and protect the global economy against the negative externalities we would all face if a GSIB were to fail. This also means that the minimum bail-in level required under our legislation of at least 8% of balance sheet can be bailed in safely. How will investors deal with these bail-in prescriptions? There's no doubt that the prospect of being drawn upon will render investment decisions more difficult. But this is also what we want to happen. The market's prudence and discipline are necessary and important preconditions for their efficient working. It still remains a big challenge to implement these rules successfully. Markets, however, have moved towards credit intermediation beyond banking. So far, we do not have an established regulatory framework compared to Basel here, and to be frank, we all still suffer also a considerable lack of internationally consistent data. The G20 has started to tackle these deficiencies, but some of these moves will take time, will take more time. Therefore, it is even more important that the G20 last year took up a German initiative and agreed on a binding roadmap to further push and steer the necessary work on this topic of shadow banking. Regarding the markets for repos and securities lending, I would like to direct your attention to the 11 recommendations the FSB published last year. I'm sure you're well aware of them. The FSB has also established a data expert group to develop and propose standards and processes for global data collection by the end of this year. And in Europe, the Commission has published a proposal for a regulation on reporting and transparency of securities financing transactions. These are still promising steps. These are all promising steps into the right direction, but you can see from the title that there's still a lot of transparency gathering involved in the process, and only when this transparency is really there, or we feel much safer in the assessment of the data we have, I think we can come to a definitive set of rules. By the Brisbane Summit, again this year, we expect the FSB to come forward with recommendations for minimum standards on methodologies to calculate haircuts on non-centrally cleared securities financing transactions, and we also expect to see a framework for mandatory haircut floors. The level of these floors will probably be quite low and fall short of what market participants tend to ask in today's daily practice. These low levels reflect a very careful regulatory approach. At the same time, the market's conservative haircut levels today indicate that the crisis has not yet been fully digested. However, this may change, and haircuts could well run towards the bottom again in more optimistic times, and that is why we need these mandatory floor levels. Last but not least, I would like to mention, and this is something that affects all financial sectors, we will need progress regarding reliable financial benchmarks. I think what happened in the context of LIBOR and FX trading goes to the heart of trust in the financial system, and financial markets, in our view, will not be able to regain integrity and, in effect, their efficient functioning without addressing these issues. Identifying systemically important or significant institutions outside of banking insurance is another field where we need to advance. We expect the FSB to recommend a suitable methodology by the Brisbane Summit. A first consultation draft was published in January this year. This is a more difficult undertaking than the one in banking and insurance, but it is a necessary process. And it should acknowledge that we are looking at a very heterogeneous group of enterprises here involving a great variety of business models, risks. This renders the work more difficult, but it is also a motivation rather than a barrier to continue. Then we should not forget that neither Lehman or AIG financial products were traditional bank or insurance activities at the time the crisis struck. Let me close my little overview along regulatory reform on a more positive side, perhaps for this audience, by appreciating what financial markets can do and are doing to finance the world's economies and to support economic growth. I think by the regulation having been enacted so far, what we do see is that we have much tighter regulation on banking, and people start to see the reaction in the markets, and people, especially in Europe, start to see that this does mean that we need other ways, especially in terms of access to capital markets, to replace at least part of what banks have done in the past to finance the real economy. I think this discussion is growing, especially here in Europe, and I think this offers new opportunities for products and developments to look at. Securitization in particular has potentials here, and you will have noted that the focus of discussion on securitization and the connotation has changed significantly in the last 6 months. We must acknowledge that securitization markets still suffer from the breakdown of trust and confidence experienced during the crisis. But we must also look how these markets can be revived and how their potential for providing specialized financing, in particular to small and medium-sized enterprises and long-term and infrastructure engagements, can be reactivated. Needless to say that such a reinvigoration should not give rise to new stability risks, so it will be very careful to distinguish here. Capital requirements should never be loosened beyond what relates to the actual risk profile of any instrument, and I think another very important lesson is that one of the root causes of the crisis in 2008 was the sheer complexity of the products, that nobody really understood what was the product, neither the lawyers nor the risk experts dealing with the products. So we continue to think that it is possible to identify some clear features of high-quality securitization. There's a G20 work group working on this. There's a development in Europe trying to develop these standards, and that high-quality securitization can be distinguished from riskier types. So I think we should move forward. Why not establish these high-quality securitized products as a separate asset class? And why not factor the lower risk levels involved here into our prudential regulation? That process has started, and I think it's something that will continue. So summing it up, yes, there has been a tremendous change. I think the focus in the next month and years will be more on implementation than on completely new set of rules, and that is a huge burden. Only when everything is implemented, people will start to realize how things work together. But I think there are also new opportunities and developments to explore in a hopefully better and safer regulatory environment in the future. I wish you an excellent conference. I understand it does close in time tonight, that you have a chance to also see parts of the city and tonight's game. So I wish you a very good time here in Berlin and a good conference. Thank you very much.
I'm not sure whether we've got any questions for Dr. Holle at this stage. Has anyone got? Kevin has, which I knew would be the case.
Thank you, Dr. Holle. I found that very, very interesting. One of the things you said early on, I think, was that there had been tremendous progress made with the regulatory reform post the crisis, but the public's perception might not match that of the market or regulators. What could be done, or what can be done to narrow that perception gap? Because I agree with you. I don't think the public believe much has actually happened.
I think there are a number of strands here. One is very difficult to influence, and that's simply and bluntly the criminal prosecution of the things which are really in the public perception, especially the LIBOR thing. I think as long as these investigations are not over and not clarified, people do not see that justice has been done. That is something which is over to investigators, regulators, and courts. So I think that's nothing which the rest of us can influence dramatically. I think a second point, however, where action can happen is, do the people get the perception that there's a visible culture change in the institutions concerned? Have they understood what has happened, what the target of the new regime is, and what that means for culture within the institutions? And I think the third step is there are still a number of questions where also a fairly large part in the professional community says this is something we have not yet solved. I would only mention two, and that's too big to fail, and that is shadow banking. If you ask major regulators today, are these issues under control and solved? My guess would be, without using your e-voting system, that the majority would say no. We still have open topics, and I said the same myself. I would agree with that. So I think it's important to close especially these 2 points, because they are considerably opaque notations, connotations, too big to fail, shadow banking, that does evoke distrust. And I think to enable regulators, especially on the G20 level, to say, we have identified the issues here, we have a concept in place, it will take time to implement, but the concept in there, I think, would be another important step to address this issue.
Okay, any question in the middle here? We'll just get a microphone to you, sir.
Dr. Holle, You mentioned critical benchmarks. Many German banks left a critical benchmark, which is Euribor. The fact that the BaFin is requiring capital for being member of a benchmark, requires capital from a bank. Do you think the regulatory impact on this fact that banks were leaving critical benchmarks is, with regards to the EBA-ESMA recommendations, a German phenomenon, or what do you see the reasons behind that? Or only German or mostly German banks left this critical benchmark? Which kind of role you see with the BaFin with regards to that?
You will understand that I will not comment on individual supervisory action, but I think what is underlying here is a more general trend that in the past, most organizations, and I would say definitely industry and perhaps partially also in the regulators, underestimated the challenges of having proper processes in these benchmark setting regimes. I mean, if you recall the public debate when the first public discussion on FX broke, most reactions also under market professionals were, well, they are so large, these transactions, I don't really see how they could have been manipulated. And this discussion does turn. So I think that was underestimated. So I think it was a correct reaction to say we need more precise, open to compliance, defined processes. How do we deal with such? I think that's inevitable. The question, is the burden too heavy? That depends on individual situations, but I think that was inevitable. What we do need, and that I think may also address part of your question, and which is why we are pressing for finalizing the European benchmark regulation quickly. Unfortunately, it's not on a fast track right now, and we have a very narrow gap for legislation this year because the Commission only resumes in November, basically. But we would think that it's very important to finalize the work on the European benchmark regulation so that at least everybody in Europe has a clear understanding of what the right processes for benchmarks are, how they are to be implemented in the organizations, and how this will be overseen by supervisors and compliance functions.
Hi. One of the, I guess, key concerns from the securities finance business or industry is the application of the FTT on its transactions, and there's still, I think everyone agrees, no real clarity on how far FTT will extend into securities finance transactions. When do you think we'll see clarity on that, and what's your view on that application?
It's not the easiest process in the world to get a solution on FTT, so I'm a bit hesitant to make very firm predictions on that. The roadmap which was agreed on is that by the end of the year there should be a much clearer picture. There are working groups now between the 11 member states which have committed themselves to implement this, which basically meet on a bi-weekly basis and are indeed going into the details. I think some parts are clear. There will be something on shares, that's clear. How far beyond in terms of derivatives and which part of that and how that will be implemented, that is discussed now, but I think the roadmap agreed on will, has the goal to provide a clearer picture in the second half of the year.
Okay, any more questions? All right, Dr. Holle, thank you very much.